Good morning. So, Richard. Oh, no, it's gone again. Try again. Hi, Richard.
Hi there. How are you?
All right, thank you. Right, we can hear you right. That's brilliant.
Perfect. Yeah, no, sorry about that. I wasn't sure if I used the right link or not, but yeah, no, I think you just needed to unmute me. That's perfect.
Yeah,
Thank you.
exactly. Yeah, you came on and then you just
I
go.
panicked. I panicked. I
Right.
thought, oh, I've gone on the the general login. So yeah, thank you.
Brilliant. All right, then. We're all good to go, I think. So, if you don't mind putting yourself on mute till we're ready for you,
Okay,
of course, past
sure.
just say. Okay, fantastic. Thank you. Talk to you in a bit.
Thank you.
Okay, good morning, everybody. This week's guest is Richard Pindar from Nipsey Capital. But before we get to talk to him, I've got a bit of news to run through. Those are the three things that I pulled out. So a couple of European renewables first. It's obviously trading on a discount, as are most of the funds in the renewable energy sector. And that discount's got an awful lot wider since interest rates started going up. And that's been a problem. It's a reasonable size, I think, 270 million euro market cap. But back in December last year, there was an announcement that Octopus Renewables made that it wanted to merge with it, which is completely unsolicited. But they had actually been pushing the board of the Credit European Renewables for a tie-up since March 2023. It looked like it might make sense in that, or its discount was significantly tighter than Ares at the time. But apart from that, there didn't really seem to be an awful lot of logic behind it. It just felt like if we make it bigger, that would be great, and not much else really. So it was obvious that Ares were just going to ignore this. They had to go and talk to investors and find out what they wanted to do. So they kick-started a strategic review on the back of this. And not surprisingly, everybody got quite excited about this. And they had a number of approaches. So they actually started due diligence with a number of people and told the market this on the 26th of February. And at that point, I would have said, oh, well, that's it, then it's probably going to disappear. But what has happened today is that they've said they've had offers of mergers. So the Section 110 scheme that we've talked about before, which is basically involves effectively liquidating one fund and folding it into another one, but doing it in such a way it doesn't crystallize any gains. Two of those approaches were just all share mergers, just not the two things together. And one of them said, we'll give you a 10% cash exit. And how that was funded has not been outlined, but nevertheless, it was there. And they said that the implied valuations were at a small premium to a discount to the current share price. And that's the point I wanted to underline there, is to the share price. So you're not going to get any kind of like NAV from doing this. And so if you're not going to close the discount, it comes back to what's really the point. And you do need 75% of those voting to approve it. So if anybody's got a 25% stake, it's got a big enough stake to block it. And they've already said that holders more than 25%, so they don't want to do one. And that probably is because these things are quite expensive. So if those kind of Section 110 kind of mergers are off the table now, the board's saying, well, we'll have to think about, does it make sense to do a managed wind down or just sell the portfolio? If they do the wind down, it's obviously not going to be a quick process. They might not get back NAV for it, so you might be destroying value that way. And it just seems to me to be incredibly frustrating that we need all this money to invest in all these renewables. We definitely need renewables. We definitely need the money. And just shrinking the sector for the sake of closing a small discount doesn't really seem that productive to me. There must be a more imaginative way of doing this than that. So I would prefer that it carries on, but what it could do is, as many other funds have done, is say, well, we're going to sell a slice of the portfolio somehow, a little part of it, and use that money to fund more buybacks. And I think that would tick the box in terms of addressing its discount a bit, but actually preserve the benefit of having this money in the system for the future. Obviously, Orit has said, well, fair enough, then we give up. But actually, since all of that was announced back in December, the whole situation has switched so that Ares now on a tighter discount than Orit is. Orit's now embarked on a strategic capital recycling program of its own, so selling stuff off to pay back stuff, to buy shares and things. I think again that's a sensible option for it to do, but it just shows you that knocking it together back in December probably wouldn't have been a great idea if the discount was going to head up to a wider discount than Ares on now anyway. That's that one. North American Income. This is a fund that we actually quite like, but it's struggled a bit, as we'll show you, in terms of performance numbers relative to the American market. It's still a decent size. The discount's a little bit wider than it should be. So anything wider than 10, I think, is a bit too wide for an equity fund. And then the surprise this week, it's actually off to James Henderson. So it's it's basically got the whole deal lined up. It's going to shift its alternative investment manager to James Henderson. The manager, Fran Rodano, has resigned from Aberdeen, and he'll then pitch up at Janus and run the portfolio. Once he gets there, there's a big depth of resource available to him. So massive analyst team, a lot of other fund managers listing US equities. And obviously, the other thing about James Henderson, and they stress this in the announcement, is that they've got a really good record of running income funds, and they don't have one in America. So this just made complete sense to me. They, as a sort of sweetener, are chucking in a cut to the management fee that I reckon saves you about 625 grand a year up front. And obviously, if they can expand the fund above the 500 million mark, which is about roughly where the assets are now, then that will kind of accelerate in terms of the benefit. And they're also making a contribution to the cost of moving the fund over, which won't be enormous relative to the cost of doing some kind of merger or something like that. They have made it contingent on getting through its continuation vote. I don't think that was going to be a problem, despite the numbers you see here. Although it's sort of bottom of the sector over 5 years, it does have a very kind of different remit to most of these other funds. And it's not had the benefit of what everybody calls the Magnificent Seven, but really Apple's gone nowhere and Tesla's gone down. So Magnificent 5.5, I think. Because it's been looking for income, it hasn't had the benefit of those. It benchmarks itself against the Russell 1000 value index. It hasn't quite managed to match that either. The board is hoping, and I think I'd give Fran the benefit of the doubt, that if he goes to Janus, that will turn around, and with sort of a fairer window of the markets behind him. So yeah, I do think this is a good move, and it should definitely get through its continuation vote. And then the important thing is just then all about delivering the dividend growth, which has got a good track record of doing. Last one of these is the other big surprise of the week, which is the little minnow, Ashoka Whiteoak, only 34 million market cap, saying that it wants to bid for Asia Dragon. So there we go. 650 million market cap, was on a much wider discount until this announcement came out, and has now gone shooting up. So this was all announced on the Tuesday. This is a Section 110 scheme, so again, we're going to need 75% approval. They're giving a cash exit opportunity, and it's an enormous one. It's bigger. I'm struggling to remember if there's been a bigger one than this, but basically they're saying up to half of the fund can get out at a 1% discount to the formula asset value, which is the NAV less the cost of doing the deal. So that's an enormous incentive for people to tick the box, because if they were getting frustrated with being an Asian Dragon, this looks like they can get out really quite close to the NAV. And unsurprisingly, I suppose, because there are quite a lot of discount players in there, they've already had supportive feedback from holders of 56% of Dragon shares. They've been talking to Asia Dragon about doing this deal for a while, but the Asia Dragon board went quiet on them, so they decided to go public with it. This is not a bid, so they're not in any kind of formal offer process here that's triggered by this, but it's still a proposal. But it's going to be really interesting to see what Asia Dragon come up with, and it's also interesting that it's taking them an awful long time to respond, which I think means A, that they were slightly blindsided by this, and B, that they are looking at all the options, and there are a range of them that they could do that mostly are would involve, I think, some considerable kind of shrinkage of the fund. So obviously, the whole argument for the Ashoka Whiteoak structure which they use very successfully with the Indian fund, is that it's got a zero-based management fee, and instead they only get paid if they outperform the benchmark, and even then they get paid in shares. So people love that, which is great. I did a little thing before about how that works out in practice. So you end up probably paying around the same kind of fee if it performs. But obviously you've got this kind of comfort that if it's not performing, you're not paying anything. They've also got an annual redemption opportunity, and that's again another big tick in the box if you're a discount player. So even if you don't get out on this massive 50% discount thing, you've got another opportunity down the line. And it has got quite a good track record and is quite well regarded. But having said all of that, the 1 year numbers are only kind of middle of the pack here. I think they are better than the benchmark. What they haven't got on their fact sheets, they just don't have any performance numbers at all, and they are stressing the point because the last fact sheet was the end of March. Then they didn't have a 1 year track record, and they're saying there's not a long enough period for people to judge them by, so we're not going to tell you what performance has been, which is one way of doing it. I think it's kind of reasonable. It is really early days on this now, and you look at some of these other ones here, and there is a kind of special thing going on. Golf's obviously been the big winner here, notwithstanding the bounce that Jima's had. If you've been in the Gulf markets and you performed as well as it has, that is the one you wanted to be in. And I was kind of hoping when we were thinking about who's going to do a deal in the sector, who might bid for somebody else, I was kind of hoping that Gulf might do one. We'll wait and see what happens with that, but it doesn't matter. The surprise one has been the resurgence of Fidelity Emerging. That's done really well, having completely shot itself in the foot when they took on the mandate from Genesis by going into Russia and then losing a whole bunch of money straight away. And the other one that is a strong contender relative to Shaker is probably Mobius. It's got a kind of ESG type thing going on here. But I'm sure the Shaker people would argue that, again, it is still early days, and here, this is the proposal on the table. But I'm just giving you all this because, as I say, the Dragon lot are going to be looking for alternatives. And the relative performance between the Shaker fund and Dragon fund is just sort of for scale. So 5.9% over 10 years is really awful. And it's really no surprise that there's something to be done. And again, that was the criticism. So Dragon expanded by merging with Aberdeen New Dawn, and people just said, well, that doesn't really make a lot of sense because you got two funds that were bottom of the table, and you just now got one bigger fund that's bottom of the table. But now that one big fund is probably going to disappear. Does it make sense to merge an emerging market fund and Asian funds? Yes, kinda. I mean, if you look at this chart here, this is just the last fact sheet from the MSCI Emerging Markets Index, and you can see how important Asia funds and the big China, India, Taiwan, Korea, how big they are within the Emerging Markets Index. So from that point of view, you're not actually shifting the assets that much away from what it was doing already. I think there's another stat that I didn't put in there. About 90% of the Dragon portfolio is actually in things that are classified as emerging markets. And there is a strong overlap between what's in Ashoka White Oak and what's in Dragon, which again is interesting given the massive gap in performance. And 9 of the 10 largest stocks are the same too, which again is interesting. But there are the obvious things, the TSMCs, the Samsungs and stuff like that, which everybody seems to hold. So we'll just have to wait and see what happens now. But all Dragon have to do is convince 25% of shareholders that this isn't a good idea, and it won't go ahead. But to do that, they're going to have to be inventive. So the final thing I put on here, this is a really scary slide now. This is all the funds that Aberdeen has lost in the last 5 years, and it's a blooming long list. So obviously they made daft idea, I thought, was getting rid of Aberdeen Emerging. I thought it was a great fund. Nevertheless, they turned that into Aberdeen China along with Aberdeen New Thai, and then they've lost that to Fidelity. Frontier Markets, they just threw the towel way too early, and that they should have persevered. Aberdeen Japan's gone off to Nickel Active Value. Aberdeen Latin American, they just fell on their sword just before Latin American markets started to turn again. as we talked about, New Dawn, they stuck into Dragon, and then that's now on the block. Aberdeen Private Equity Opportunities has just gone off to Patria. Aberdeen Smaller Companies Income, they've managed to retain that because that went into show as income. North American Income's obviously just going off to James Henderson now, and the UK Commercial Property REIT is being taken over by LXI, or LMP, right? And then you've got Aberdeen European Logistics Income, which is in the throes of another great strategic review that's sort of got ongoing. Aberdeen New India, where I'm sure I saw a story the other day that Indian Capital Growth would be really quite interested in taking that over. And then Aberdeen Property Income, which has fought off one idea, but is now considering whether it wants to wind up or not. So it's not great. Really, they've got to do something about it. So enough from me. Now let's talk to Richard.
Hi, James.
Good morning.
Morning.
Thank you very much for doing this again. It's been a while since you were on before. So I'm going to let you, as usual, just introduce the bit first, and I won't interrupt you for a bit, and then we'll have some questions from the audience. And if you want to ask a question, just put it in the chat box, please.
Great. No, thank you for inviting me and hosting me. That's really appreciated. It's been 3 years or so, I think, since I last spoke to you or presented on Literacy Capital. So I'll just give you a bit of an update on what we're doing, what we have been doing. So what we seek to do, as I said, we listed in June 2021. We arrived on the market then with net assets of £96 million. What we seek to do is to invest in UK businesses, private businesses, and help those founder-owned businesses go on the next leg of their journey. That's kind of deliberately vague because often the founders want different things, and we try to accommodate what they're seeking to do. You can see there from the second bullet, the growth of the fund's been reasonably good, the performance. So it's grown organically from 96 million to in excess of 300 million of market cap and NAV. I guess what we also try to do with the businesses that we've got is actually, I guess, add tangible value or help to them and assistance. Often there's a reasonable degree of change in those businesses. So having some experience and a track record of being able to help similar businesses in similar situations add value to them and help them have kind of smooth sailing going forwards is quite important to those founders that we're dealing with. In terms of structure, I mean, given we kind of sit firmly in the private equity segment, it's quite an unusual structure. So we've obviously only got one fund. We make direct investments. We don't make fund investments. We do, but a very small part of what we do. So we have kind of control over the timing of investments and I guess realizations. The fees very low, 0.9% management fee. Normal management fees in private equity to private equity fund managers would be 2 or higher % per annum. There's no carried interest payable to the manager on top of that, which again is extremely unusual. So ends up improving net returns to shareholders. And then on top of the fees and the cost, there's also a pledge to donate 0.9% of net assets every year. So obviously, as net assets increase, then the donation per annum increases in line with growth in NAV. So that's a very quick overview. If we just turn to the next page. A bit more on what we actually invest in. So I touched on UK-based private businesses. At the smaller end of the scale in terms of size, so we say 1 to 5 million of EBITDA. Sector, a real mix, as long as we can understand them and think we can add value, understand why a customer might buy a product or a service, that's obviously important. Financial profile is important. We want to make sure that the margins are good, the cash generation is good in those businesses that we're backing. I guess an important point to make is the part of the market that we look at. There are obviously lots of an increasing number of private equity managers out there, and there's an increasing amount of dry powder looking to invest in private businesses. But we quite deliberately seek to focus on the smallest part of that market. So, the private equity market has grown. The successful fund managers have increased the size of their funds. When they increase the size of their funds, they then tend to have to focus on larger businesses. So, they don't tend to then focus and fish in the same ponds that we do. So, again, it just means there's less competition for the types of businesses that we want to invest in, and that's reflected in the prices that we pay for the businesses. Debt, a common criticism of private equity is the amount of leverage that's used. The leverage we use is far lower. The types of situations that we tend to see, as I touched on, all of the businesses we've ever invested in have been founder owned. At the point we've invested, they've never had external shareholders before. And being able to deal with that situation and the challenges that those businesses might have is I guess, a skill set of its own. And being able to develop a good relationship with those vendors is critical. And then again, finally, given the situation we often encounter, those businesses, we often, we can't just leave them completely alone. They often need some love and support. And so, across the 22 investments that we've made, we've on average tended to, add 2 or so senior execs to those businesses in an executive or non-executive capacity. In some cases, it's been much more than the average of, say, 2 and a bit people per company. We can kind of really cookie cutter approach to what's really needed in that company. So those are the sorts of situations that we tend to look at, and the types of businesses and size that we want to focus on. We just go to the next page, and again, it just gives a bit of an update since the listing, how things have developed. I guess we've invested reasonably consistently in the period since we listed in June 2021. I guess a point that we've made reasonably consistently in recent publications, fact sheets, accounts that we've published, the level of cash proceeds has been increasing, and we do expect that to continue to remain reasonably high. So if you look in 2023, in each 6-month period there, we generated in excess of 20 million of cash from each H1 and H2, and then actually in Q1 this year we almost generated another 20 million pounds, and that's obviously just a 3-month period. So as the businesses, I guess, gain age and maturity and size and scale, there's a greater likelihood that there might be realizations. They also have the ability to return cash to us, which is what generated the cash that we received in March, so in Q1 24. And then again, just sort of linked to that, the uplifts that we've tended to be able to generate, all of the transactions that we've announced by the RNS are listed there. So, reasonably material premiums, 53%, 49%, etc. In line with carrying value for HomeTree, following a 325% premium to carrying value, and then Yfinity also 110% premium. So where we have had transactions, and this is often the case with private equity funds, the premium that have been generated on those transactions have been quite substantial. And if we just go over the page, I guess you can see the performance of Book Literacy Capital since the listing. We were unusual in that we were actually set up and we were private for a period of time because we wanted to be able to list when we were reasonably fully invested. So we weren't just a cash shell with the cash drag that comes with it. So there's the 2 periods there. So June 21, as I've said, was the listing, and we actually set up a little over 3 years before that. So there's a slightly longer track record as well. I guess you can also see the relationship or the correlation between share price and NAV. So for a reasonable period post the listing, we traded at a premium to NAV. And I guess since the later part of 2022, the share price has tended to trade reasonably closely in line with NAV, which again is relatively unusual in the private equity segment in recent times. Let me just turn over one more page, James. Here we've got, I guess, an important slide showing the composition of the portfolio. Reasonably concentrated. It's obviously worth pointing out RCI and Grace. I guess between them are approximately 45% of the portfolio. I guess the important point to make is our collective investment across those 2 investments was sub £5.5 million. So we're not making outsized investments or bets in individual companies. We're just allowing the successful investments to compound and grow. So, RCI, including the cash that it's also returned to us, we've now made 33 times our money. Grace, again, inclusive of the cash that they've returned to us, is in excess of 26 times money. And so we're more than happy. And again, with the structure we've got, we don't have the financial incentive that private equity managers do, where they have a successful investment. They want to start promptly thinking about how to sell it, because their limited partners want the cash back, because that's how their fund, that's how their own dynamic works. And also themselves, that's how their own financial incentive works. If they have a very successful investment, that will generate a significant amount of carried interest for the private equity fund manager. And so again, that dynamic is just not applicable to us. So it means we can hold on to businesses ourselves and keep the upside within the trust rather than selling the business. So that's, again, just a quick portfolio breakdown. I'll just do a quick, perhaps 1 or 2 minute summary on the most recent investment that we completed in March of this year. Again, it kind of brings to life many of the kind of points that I've just touched on. It was a business that was set up 8 or 9 years before we invested, set up by 2 founders who own the business 50-50. They wanted to de-risk. They wanted to bring on board a minority partner who could help them take the business on to kind of a continued journey of growth. The 2 of them didn't want to leave the business, didn't want anything really to change in their own roles, still very keen on working with the business, could see lots of growth in the business, but equally could see the value in, I guess, bringing on board a partner, an investor that had taken businesses from, as you can see there, 20 employees, 12 million of revenue. If they wanted to get the business to 30, 40, 50 million of revenue, they appreciated that the business might need, to be run and structured in a slightly different way over time. So that's what we've done. The business itself provides entertainment onto cruise ships predominantly and hotel resorts. Increasingly common that cruise ships want to provide the best possible product and service on board. If the entertainment or food is poor, then people are unlikely to come back the following season. And so, the focus on providing a really good service and experience for people on board or in hotel resorts is an increasing focus. So the spend and the I guess the opportunity there to win clients is increasing as time goes on. So it's a very quick summary on Live. And just a final page here. Again, many of the points that I've previously made, we want to invest in, growing UK businesses and help them to accelerate their growth. Performance of book thus far has been pretty good. Portfolio companies are trading well. Significant skin in the game, financial alignment, low management fee, no carried interest. The fact that the directors, or rather the founders of Book and the investment management team, between them own nearly half of the fund. So again, our financial alignment is very strong. And then again, finally, that unique charitable objective. So despite the growth from 54 million of net assets to 110, we've also given away just over £9 million to charity to help disadvantaged kids to read. So it's a very quick whistle-stop tour of Literacy Capital. Very happy to take any questions that people might have.
Brilliant, thank you. It's a great story. Let's start just on the business here with the third-party funds. What was the thinking behind including them in the portfolio? Are they there to stay? What's the kind of plan for them?
Yeah, no, it's a fair question. So almost all of that comprises funds that we made commitments to in 2017 and 2018. So as I mentioned, when we set up as a private entity, we had a business entirely consistent, or a balance sheet consisting of cash, and we wanted to be able to, I guess, invest and deploy that capital prudently, sensibly, and so rather than obviously earning back then a return of 0 on that cash, we wanted to have a way of earning a return. So we obviously have some relationships with sort of high quality private equity managers. Those relationships also allowed us to invest without fees and carry. And so it was just a means for us to deploy some capital. If you look at recent quarters, the cash generation from that part of the portfolio has been disproportionately high. And we expect that to continue. So I would expect that to shrink as a percentage and I guess in absolute terms as well. So it was just, I guess, opportunistic on our part. The funds have performed pretty well, particularly again as we've not had to pay fees or carry on that. But it's not a core part of what we expect to do going forwards.
Okay, fair enough. In terms of the kind of value creation that's going on here, is how much of it is growing the underlying earnings of these businesses, and how much is kind of multiple expansion?
Yeah, it's a good question. I mean, the majority of it is, relates to earnings growth. I mean, the vast majority of it. I mean, the kind of the thinking really is, we only want to. The average valuation that we invest in a business is probably somewhere between 7 and 20 million of enterprise value, and we kind of view the business through the lens of, if we can't get the business to say 100 million plus of enterprise value, then it's probably not worth our time and effort. Obviously, some part of that we would assume we can get some multiple arbitrage, because again, going back to the point I made around the part of the market that we focus on is disproportionately underserved, because for most private equity fund managers that aren't investing their own money, they're investing third-party capital. It's uneconomic for them to be able to focus on the size of business that we do, because they've got to manage a certain size fund, they've got overheads associated with it. And in order to manage a pot of money, they need to sort of focus on bigger businesses than we do. And so there doesn't tend to be much competition, and any competition we do have tends to not be particularly strong, because if they were stronger, they would be raising and managing a bigger fund. So as part of, I guess, getting from, say, 10 to 100 of EV, there will obviously be some multiple arbitrage, because we then want to get our businesses to a level of maturity, size, attractiveness where, there's a lot more options at the point that we come to sell them. But equally, you can't go from 10 to 100 million of EV without improving or scaling the profitability and the level of sales and revenue that those businesses are generating. So it's a mixture, but obviously to get to that level of growth and the level of growth some of these businesses have seen, it's much more heavily weighted towards sales growth and improvement of the businesses, rather than just relying on multiple arbitrage.
Can you give us a steer as to how those companies have been doing? Because obviously the economy's not been brilliant last couple of years. Are they growing much faster than the general economy?
So I guess every fact sheet we produce, we publish the year-on-year sales growth, and the year-on-year sales growth in the most recent couple of fact sheets has been the weakest we've ever published, for exactly the reason you allude to. I mean, it was very noticeable in H2 last year how weak market conditions were. Our businesses generally were outperforming the market, so I think year-on-year sales growth that we published in for the quarter ending March was I think it was around 13%, something of that order. So it was low double digits, but it was a real grind and a real battle in some cases to achieve that for some of our portfolio companies. And again, if you go back to March last year, March 23, some of the businesses had come out of COVID and had seen 100% sales growth year on year. So again, looking forward to the most recent quarter end, it was quite hard to replicate that. So even, achieving any form of growth, if you look back over 2 or 3 years, it still was a pretty good outcome and performance from some of those companies. So yeah, I would say, and we alluded to this in some of our fact sheets and commentary, it was quite tough going in H2, but we have seen things improve. And I think the GDP announcement was this morning, where it's come out surprisingly strong. I think it was 0.6% growth. I would again say we could see that before that announcement got made, just by some of the, I guess, green shoots that we're seeing across the portfolio. So yeah, it's been quite tough, I would say, 2023, but I think the early indications in 24 are reasonably encouraging. But again, despite a tough macro background, as long as the leverage is low and the businesses are doing the right things, you should still be able to take market share. We should still be able to create value, which we did in 2023. NAV growth in 23, despite tough circumstances, was up 19%. Share price was up in excess of 30%, which, given circumstances, we were pretty pleased with.
I mean, it says defensively positioned here. I mean, what is it about those companies that makes them kind of defensive? Is it about the market share they've got already, or the patents they've got?
I think it's probably a couple of probably 3 things. So firstly, strength of management is always key. We always focus really hard on trying to understand the management dynamic, what the founders are seeking to do, and ensuring that the team for the future or post us investing is well resourced, it's got the right people, the right skills, it's got what it needs to sort of continue on a trajectory of growth. So people is critical to make sure that they can go through tough times well. I guess the second point is around margins. So again, if sales soften or things are difficult, you don't have a high fixed cost base. You can still generate good levels of profits, or you can still generate cash. That's not a major problem. And then again, I guess defensively positioned is around the leverage point that I raised before. I think the average leverage of a PE-backed business, generally is probably 4, 5, 6 times EBITDA. The current level for us, again, a figure we publish every quarter, was just in excess of 2 times. So again, if there's some cyclicality or there's some pressure, if there's low leverage, then you don't tend to feel it in quite the same way, and your businesses can kind of ride through that difficult period more easily. So I'd say people having good financial profile, good margins, gives you a bit more downside protection, and then also that leverage point.
Great, thank you. So you talked here about some of the realizations you've done recently, and the big chunks of money that are coming in, especially recently now. Couple of things. Does that mean that the cash position is going to go up, or have you got new investments you want to recycle those into? And secondly, is the fund getting to a size now where you don't really want to grow it anymore?
So we do have an RCF. So at points during 2023, the RCF was drawn. So we had effectively debt at a portfolio level. You can see there that I guess the net position over 23 over the course of the year was that we were a recipient of cash. And so by the end of the year, we used that cash to pay down that position. And then again, that continued in Q1. So we're not, I guess, effectively now sat on excess cash that's not earning us a return. I guess the plan going forwards, I mean, as part of the documentation that we published for our AGM, which is imminent, we did say that we would set up a B share scheme, which is, I guess, akin to a special dividend, but it just means that the private individuals that are shareholders can receive that cash taxed via or under CGT rather than income tax rates. So I guess we don't want to not grow or shrink. We still expect the trust to grow. But again, I guess going back to the financial incentive point, we're quite big individual shareholders ourselves. We could quite do with the cash. We've done this for a long period of time without ever returning any cash to investors. So I suspect all of our shareholders would welcome it. But equally, there is a balance of, there will become a time where we do sell an asset and it delivers a disproportionately large amount of cash that we can't invest in the same, I guess, disciplined way that we have done to date. And we don't want to deviate and do bigger deals. We don't want to relax our pricing discipline or capital discipline. So again, it's just an additional lever we can pull. If we think we don't need the cash and we've got excess cash, then we can return it in an efficient way to shareholders. But we still believe the trust can grow. The focus is long-term NAV growth and total return for shareholders, because that's within our financial interest.
Okay, that makes sense. So there's a question here about dividends. So you definitely B share capital gains efficient returns capital rather than dividends, you think?
Correct. I mean, dividends are tricky, I think, for the types of investments that we hold. I mean, whilst that table shows cash flows, looking quite nice, healthy, growing, the reality is, the Q1 cash proceeds was from one transaction. H2, 90% of that was from one sale. The H1 cash, again, 90% of it was from one sale. So they tend to be, particularly the proceeds coming in, tend to be irregular and lumpy. And if we start committing to regular dividends, it means we have to hold more capital back up our sleeve. It reduces the efficiency of the capital that we can deploy. So I think we would prefer to assess on a case-by-case basis how much capital makes sense to return, when it makes sense for the trust to return it, rather than kind of getting into a pattern of regular dividends. We've thus far been able to recycle and redeploy the cash that we've had well into new investments. And so, if we can use that capital to redeploy and compound the growth in the trust, we think that's the best thing to do for shareholders rather than paying out dividends for the time being.
Fair enough, that makes sense. I just brought this page up again because one of the things that I'm fascinated by is how do you actually find these companies? So this one as an example, maybe, but maybe just more generally, where are you getting the ideas from?
Yeah, I guess the majority of the investments that we have come to us, we've got a team at Literacy of 8 or 9 people. Everyone that's in the investment team has a responsibility to go out and speak to the network of people out there that know these business owners. So there's a network of whether it's wealth managers, tax advisors, corporate finance advisors. Corporate finance advisors effectively act almost as intermediaries or kind of estate agents, matching up buyers and sellers of businesses. So I guess it's our job to ensure that as many of those relevant people as possible know of the types of situations and businesses that we can be helpful to. And so, Live specifically came to us through somebody that I've used to work with a long time ago. He let me know of a business that the company that he worked for had the mandate to kind of sell and find an investor and partner. Kind of gave me the headlines. I said, sounds very much up our street in terms of situation and size. The business was growing very nicely. We met the 2 founders, Mark and Dan, both absolutely delightful chaps. We put a proposal to them, I think within 48 hours. And then within 10 weeks of us putting that proposal to them, we managed to complete the investment. So it's through, it's through a lot of conversations. Many of them obviously don't lead anywhere, but the more people you talk to, I think it's the old Gary Player quote of, the more practice and the more stuff you do that's good, the more good outcomes that you see. So it's just being out and about, being in the market, speaking to the right people, explaining to people what we do, why we're good partners. And I guess the thing that's almost most valuable to the vendors or the founders of businesses that we speak to is our ability to transact quickly and to be straightforward. So, a message we always give is every single deal we've ever done, we've always done on the same terms that we've then ultimately completed on. Because again, private equity falls into this habit, which is just a poor habit to fall into of, changing terms or chipping, during processes. We've never done that. We never would. We don't think it would be good for our reputation. And as a result of that, we do see a lot of repeat deal flow from people that we've transacted with in the past. And the other thing also that's of value to founders is demonstrable examples where we've been able to help founders of businesses years later, sell their businesses for significantly more. And, some of the stuff that we touched on, RCI and Grace have obviously done very well. They're still in the portfolio. But we also sold 2 businesses in 2023, Butternut and Kernel, where in both cases we made over 10 times our money. And again, being able to demonstrate that to potential new investments, they're going to often remain, or they will always remain, meaningful shareholders in their business. And often it's not just financial, it's also, I guess, a source of pride. It's a business they've worked with for years or potentially decades. They want to know that their management team, their employees are going to be well looked after. So actually being able to tangibly say, look, these are how our business has performed is often more important to them than the pounds and pence that they're going to receive at completion for their business. So it's a whole variety of things that, when we get to meet these founders, that we need to kind of touch on and explain to them and sell to them, really.
Great, thank you. Just one specific question about TechPoint. Can you sort of talk us through what's been going on with that last year and this year, please?
Yeah, so TechPoint in, I guess, 2023 was, I guess, one of the weakest performers in terms of, negative uplifts, if I can use that terminology. I guess the reason for that is it had such a strong period coming out of COVID. can go into many levels of detail, but if you looked at everything that was going on in the electronics market in, say, 2022, kind of everything was going in their favor. So supply side constraints, there were issues with the Suez Canal being blocked, there were issues with Taiwan, there were issues with China, which ultimately benefited their level of profitability because, pricing went up, availability of parts sort of went down. So all of that bolstered their performance. And again, going back to a point I kind of made before, but specifically was an issue that TechPoint experienced in 2023. It was never likely that business was ever going to be able to repeat what happened with some of those one-off factors in 22, which positively impacted financial performance. It meant that they were unlikely to be able to repeat that. So now TechPoint has kind of reached a more even keel, back to a more sustainable level of trading. But that unwinding of effectively excess or unrepeatable earnings had a bit of an impact negatively on 2023. And then obviously that's reflected in the carrying value. So yeah, it's still a good investment for us. I mean, it's still valued at many times more than what we put into it. It's just not valued quite as positively as it was, say, 12 or maybe 15, 18 months earlier because of those market dynamics.
Okay, great, thank you. We are sort of running out of questions here, but there's one about your rating. But the question is actually asking what the strategies are that kept the discount narrow. I would argue that you haven't really done anything apart from perform well. But I suppose there's the question, when it was on a big premium, did you think whether you should be issuing stock or not to bring that premium down?
The honest answer is no, we didn't. I guess to answer your question, we didn't ever wish to. We felt we had enough cash to deploy to sort of suit our needs. We kind of felt as well, even if somebody has paid a reasonably big premium in 2021 or early 22, they've still made a reasonable return for themselves. So again, that's kind of worked out okay for them. I guess our approach to the discount, I mean, there have been pretty brief periods where we've been on a relatively modest discount. And we have said in fact sheets and in commentary that if the discount persisted or got wider, we would buy back shares. I guess we've not wanted to buy back shares in reality because of the types of returns we think we can make by deploying the capital into new investments. So that's one reason not to. I guess the second reason not to is we're already reasonably tightly held. We would prefer, I guess, the share register to become more normal, less concentrated, to be able to have more institutions buy shares. That's the only one real criticism we ever get from institutions is, well, you're not quite large enough yet. And we say, okay, well, give us a couple of years and we'll try to be. But we're not planning to go and issue more shares to make ourselves bigger. Again, our focus is solely on accretion of NAV and share price through organic means rather than just increasing size in that respect. But yeah, it's obviously topical because there are lots of trusts out there in all sectors, but particularly in the private equity sector where the discount is substantial. Some of them have done certain initiatives to try to close that. I think some of them could have done a lot more and could have communicated a lot better or designed schemes that could have been better. But I think the performance within private equity over the long term has been good from a NAV perspective. There's just there's a few factors at the moment as to why the discount is quite wide, but I would hope over the medium long term that starts to disappear. Yeah,
I think it's important to remember too that your NAV is quite conservative. If you look at the uplifts that you've had when you've been selling things.
I think that's obviously gives comfort to people. I mean, every transaction we've announced we've never sold anything for below carrying value. So, that track record is comforting. Yeah, most definitely.
Yeah. Cool. Okay. One more just on the breadth. Obviously, 29.5% in RCI is a big chunk of the fund. Will there ever come a point where you think that one position is just too big?
Well, I guess RCI the quarter before and the quarter before that was actually larger. So it was over 30%. I think it was 33 at the end of 2023. We have had a reasonable amount of cash back in Q1. So the refinancing that occurred, RCI was the business that redistributed that cash to us. So by virtue of businesses doing well, they obviously have greater levels of earnings and they have the ability to generate cash. And then some of that cash can be effectively remitted to shareholders, and that allows us quite naturally to rebalance the portfolio. But even though we've done that a few times, RCI continues to outperform the rest, and it therefore continues to grow as a proportion of the fund. So, I mean, I could answer this question in a really long form, but in short, I guess if you look at 3i, Action now is 70% of their portfolio. They've performed really well. They've performed really well because they've held Action. They've held their best performing business. Is there a level we'd feel uncomfortable? I mean, there obviously would be, but for the time being, we're very, very relaxed and very happy to be owners of RCI. I guess another point worth making, and it's the same for Action or 3i, is it's not as though we've got 30% of the business of the fund in, say, Amazon or Microsoft. We have far greater levels of understanding of what's going on in that business. I last spoke to the CEO of RCI yesterday. I suspect I'll also speak to him today. It's a far deeper level of kind of knowledge, interaction, ability for us to initiate change if any change were to be needed. So it's quite different to, say, owning a public stock where you obviously don't have that level of engagement or knowledge. So yeah, for the time being, we're delighted to have been owners of that business for the period that we have been, and we would expect to be for many more years yet.
Great, that makes sense. Thank you. One just on debt. Obviously, you're usually quite modest amounts of debt anyway, but did you notice that it was harder to obtain debt for private equity deals in the last couple of years?
I guess at our level, I would have to say no in reality, because again, often on day one, we might use one turn or 1.5 times EBITDA of debt. So it doesn't tend to be that difficult, if I'm honest. That being said, I mean, for instance, Cubo, we ended up going to debt providers. The debt offers we got were not particularly attractive. And so we ended up bridging that for a period of time, but we ended up refinancing it out relatively soon after. And so the reason we did that was, I guess, the terms would have constrained growth. They wouldn't have allowed us to invest at the rate that we wanted to, because the banks wanted greater levels of prudence and control. And so then it's a case for us to decide, well, is that attractive? Is that something we want to do? So there's a couple of businesses on that list, Hallsbury, Cubo, Oxygen, TechPoint. All 4 of those businesses, we originally did those deals with no senior debt. Three of those businesses now do have senior debt, which we've effectively brought in subsequently, often alongside us wanting to do an acquisition. So again, it allows us to complete a deal more quickly, more simply. We do have the ability subsequently to recycle capital. So it's definitely been challenging, I think, at the private equity backed businesses in general, and it's definitely why you're now seeing some multiples come down. So I think average carrying multiples, if you look back versus 12 months earlier, I suspect all of the listed private equity trusts now are publishing lower multiples versus where they were, because the availability of debt and the cost of debt is higher than it was. But to be honest with you, at our end of the market, when base rates have gone from effectively 0 to say 5%, it makes very, very little difference to our return, because the interest costs are so trivial as a percentage of the cash generation of the business. So it's not had a major impact on our businesses, if I'm really honest.
Thank you. Obviously, the UK small cap market is quite unloved, especially the bottom end of the UK small cap market. Is that reflected in the valuations of your stocks as well?
I guess you're probably mostly talking about the public markets, the listed companies.
Yeah.
I mean, obviously, as part of our valuation process, we consider what's going on in public markets, but we have always we've always given far more value and weighting towards what's going on in the private markets. And I guess we're quite fortunate in a way that the UK private equity market it globally is probably the most developed, excluding probably the US. But certainly in Europe, it's the deepest private market that exists. Private equity has been around longer in the UK than anywhere else in Europe. And as a result, there's always a good number of private transactions in the recent past that can inform the valuation. And the multiples paid for private businesses tend to be a lot more consistent than public multiples. You know, in good times, they tend to be a lot less exuberant. In the bad times, they tend to be a lot less depressed. So we don't tend to pay a huge amount of regard. Obviously, it's some data we have to collect and consider, but we don't tend to sort of focus on it too much, to be honest with you.
Okay, that makes sense. Thank you. Good stuff. I mean, it's great. It's a fantastic story, and obviously you've done extremely well. And fingers crossed we keep going. One of the things that came to my mind is like the success you have with these companies. Is it just part of it that if you took almost any company, but if you took a lot of the companies out there and gave them kind of support, in terms of the management expertise and the financing and stuff that you provide, that you could turn them into good companies? Is it the things that you're doing that's driving the success? So that's what I'm coming to.
I mean, I wouldn't give us all the credit. I think a lot of it is around, Paul would say it's around giving confidence to the existing management teams. And often it's around them having somebody to talk to for the first time, or it might be, as part of a deal, they might be allowed to take out an amount of capital that allows them to, sleep better at night, so they can be a bit more brave about, taking on new customers or buying other businesses. None of our businesses have ever bought another business before we've become a shareholder. And since we've become shareholders in our 22 businesses, between them, they bought more than 30 businesses between them. So I guess it allows them to think slightly bigger. So sometimes it's around taking the shackles off the existing team, but then equally sometimes it is around, what support can we give? What additional hires can the business make? Can it go and make 5 sales hires rather than 1 sales hire? It's around, I guess, being slightly more brave and slightly more ambitious, which is easier to do when the founder doesn't own 100% of the business, when it's all their money and all their risk that they're taking. But yeah, no, I think it's a mixture of some support, some additional confidence that they get. But then equally, we also do have to make sure that we're trying to select businesses where there are good tailwinds. There's a large enough market for, the size of the prize and the size of the business ultimately to be large enough. So there's a variety of things, I would say, to be honest with you. But yeah, it's not just down to just picking the business. I would say that the people at the heart of it are the most important factor.
Yeah, I think I agree with that. Brilliant. Thanks very much, Richard. That's really great. So
appreciate it. Thank you.
We'll follow with interest and come chat with you another time. We may. We'll be back next week talking to Mark Shepherd, who's manager of Manchester London, which has been one of the best performing funds of recent couple of years, because he's gone all in on AI. So we'll find out more about that next week. And then, as I've said a couple of times, we've got a full lineup of stuff now all the way through. I think we're getting towards October. So have a good weekend, and I will see you next Friday.